Hello, this is Steve Sanangelo once again from the SRS Rock Report, and I'm glad you're joining me today because I'm going to talk about the new age precious metal investor. It's going to be a new theme on the younger generation, of the millennial investor in precious metals. I believe we're going to see more interest from the millennial segment as time moves on. And it's known that the biggest buyer of gold and silver are the older generation, with my generation between 40 and 65 plus. But I mentioned in one of my articles, the biggest segment of demographic of the SRS Rock Report, the viewers are aged between 25, 24, and 35, and that is the millennials. So I want to talk about how I believe we're going to see more interest in precious metal investment from the millennial generation. And I'm going to do several themes of why they're going to be interested. And one of the themes is going to be on the U.S. state pension fund disaster, a reason not to be in pension funds. And so let's get started. Now, I wanted to show you this chart of the SRS Rock Report demographics, the age brackets of the followers, readers of the SRS Rock Report. And this is a chart from Google Analytics. And as we can see, the majority of precious metal buyers are known to be in this age range, 45 to 65 plus. But my largest group of readers are aged between 25 and 34. And even there's a lot in the 18 to 24 range, which makes sense. Also, they're more interested in using electronics and computers. But I did find it quite surprising that the younger generation is following my work, and I believe there's a good reason for that. And that's shown in this article. Only 23% of millennials prefer investing in stocks to cash. Here's why they're skeptical of the stock market. So here are the favorite long-term investment by generation. Millennials, their favorite investment is 30% is cash. Generation X, 33% the stock market. The baby boomers, my age bracket, 38% are in the stock market. And then the silent generation, the older generation, 44% are in the stock market. Now, there's a good reason so many millennials are hesitant to put their savings in the stock market. Many have seen investments collapse. A lot is being shell-shocked of coming age during the financial crisis. Greg McBride's Bankrate's chief financial analyst says on CNBC. Now, for the older millennials, the 2008 crisis wasn't the first either, McBride points out. Many also remember the dot-com crash of the 2000s. To see that once or twice within a period of a few years understandably scares a lot of investors out of the stocks. Now, another reason has to do with there's probably less available funds for the younger generation. It's hard to find good paying jobs to invest in the market. But I do believe a lot of them are just very skeptical of the markets because of what they've seen. They have a good innate understanding that something is definitely wrong with the market. Now, I first wanted to show you this chart. This is the global and how it pertains to gold and silver. This is the global mainstream asset universe. It was done with data by the end of 2017. It was done by Savalas World Reserve. And according to their analysis, of the 469 trillion of global assets at that time, 281 trillion were in real estate. Now we have to understand all the people in the world, in India and China and Portugal, Spain and France and Germany and United States, Canada and Brazil, wherever in Africa, most people are in a home. They'll have either their rent or they own their home. So most people have it's real estate, whether it's homes, commercial, or even farm. So most of the assets in the world are in real estate. Then we have the securitized debt, which is 105 trillion, equities, 83 trillion, and then gold and silver, 3 trillion. So if we look at gold and silver investment compared to the 469 trillion of total assets, it's less than 1%. So now what is the typical mainstream investor, let's say American, who invests in the market? What do they invest in? Well, it depends upon if you're conservative, aggressive, and your age. Normally, when you're young, they suggest you go 70% in stocks. That's the red here. 25% in bonds, fixed income, and then a 5% in cash. And that's what a financial analyst or a financial planner will suggest for an aggressive portfolio for a young person. And as you can see, there's no gold and silver in here. Now, if you get older and a moderate portfolio, you have less stock, 40% stock, 55% in bonds, 5% in cash. And as you get older and you want to retire, the typical mainstream investor moves 70% into bonds, fixed income, 25% in stocks, and 5% in cash. So now, how does the mainstream investor asset portfolio, how does it compare to the U.S. state pension fund assets? Now, we all have a good idea that the pension funds, we hear it in the news, they're underfunded, but what are they invested in? This next chart shows us. According to NASRA, which is the National Association of State Retirement Administrators, and this was as of the U.S. state pension asset allocation as of 2017, 49% were in equities, 23% were in fixed income bonds, and then they have this called alternative investment, which is 19% in private equity and hedge funds. Now I'm going to talk about that because that is the leading growth. That's the leading growth of the pension fund assets in the last 10 years. Then we see 7% in real estate. Real estate can be very risky, especially during a downturn, and then 2% in cash. So if we look at this chart from NASRA, it's the U.S. pension fund asset allocation. It's over a period of time. And right here, 2017, that's what I just showed you in that previous chart. Now, the equities, which are about 49%, they've actually fallen from 55, 60%. Now they're only about 49%. Now, fixed income, that's fallen. That used to be about 35%. Now it's 22, 27%, 22, 23%. Real estate, which is right here, that's increased a little bit, but the biggest growth is in alternatives. Now, before the financial crisis, the alternatives were about 5, 6%. Now they're almost 20. They've nearly quadrupled. So what are these alternatives? Well, they primarily are private equity and hedge funds. So again, what is interesting that we find out that the U.S. pension funds, which we have to remember, pension funds are for people who want to retire. So if you're going to retire, they should be more conservative, correct? But they can't be because the governments have lowered interest rates so low, it's hard to make a 7% return. And that's what the pension plans look for, 7% return on a conservative portfolio. You can't get 7% in bonds. So they've had to become more risky. Well, how risky have they become? Well, they're actually more risky than the aggressive portfolio in the typical mainstream investor. If we put in equities, the alternative, which are private equity, as well as hedge fund and real estate, it comprises 75% of the U.S. pension fund portfolio, 23% are in the fixed income bonds, and only 2% are in cash. Now, that's very bad because they actually should be more conservative. When people retire, they want to have safe assets. But again, the market is it's so difficult for the pension funds to make their 7% returns. They have to go into more risky assets. So again, if you consider that 49 and then the 19 and 7, that's 75% now are in more risky assets. And let's talk about this private equity and hedge funds, because that's the leading growth part of the pension fund asset. So the definition of private equity, in simple terms, private equity means raising equity privately. When the investment is made by high net worth individuals, institutional investors, university endowments, pension funds, there we go, banks, in companies, insurance companies, in a company which is not publicly held, or one which is underperforming by employing a leveraged buyout, is called private equity. And what they do a lot of times is they'll buy a public company and make it private. And so that's how a private equity fund works. Now, the definition of a hedge fund is a private investment vehicle which is not open to the general public. Rather, it is offered to a selected clients, is also called a hedge fund. It pools the funds of wealthy investors to invest into a range of securities with the help of a range of investment techniques to generate good returns. Now, what are these techniques? They include leveraged long short positions in the national and international market. Let's first look at hedge funds. Now, hedge funds were supposed to do really well last year because of the volatility, but according to this article, hedge funds' hopes for 2018 dashed amid closures. This year was supposed to be when rising volatility, which we saw in the markets, and yields brought back the glory days. Instead, returns fell and investors fled. Performance for the industry as a whole has given investors little reason to have faith. Now, this overall hedge funds index is down 2.36% this year. In 2017, it returned 8.5%. The hedge fund sector is now like the restaurant business. Few of the new hedge funds that open are still standing 2 years later. The reputation that hedge funds once enjoyed for waging lucrative, contrarian, risk-taking bets has taken a hit recently. This was illustrated by the hedge funds that lost big on their investments in Facebook, which was one of the most widely held U.S. stocks when the social network share plunged 19% on one day last July. So the volatility is supposed to make the hedge funds more profitable, but last year it didn't. So now, I believe hedge funds are going to be in more trouble during the downturn, but what is private equity? Now, taking companies private is incredibly profitable. When a private equity firm takes a company private from the public market, it has 100% ownership and can thus claim ownership of all profits from the company and have complete control over capital allocation. In short, private equity firms have unlimited control on the goings-on of a company, unlike public equity investors, and that means they can claim all the cash flows from the company. So what that means is now it's higher returns because they take the company private and now they can make more cash flow, higher returns. So the thing is, there's leverage. Private equity funds take money from investors and then leverage it with bank loans and bond issues from their newly acquired companies to boost returns for the investors. If a private equity firm takes a company private at 10 times earnings, a return of 10% a year, it can do very well for its limited partners by leverage those earnings with cheap debt. Now, the thing about private equity funds, it must exit these funds. Private equity funds are designed to exist only for a period spanning less than a decade. When the fund reaches the end of its designed life, it exits its holdings by selling them. A common exit is to sell a private equity position to a competing firm, or to list private companies in a portfolio on the public markets through an IPO. A private equity fund is kind of like a leveraged buyout cannibalization system. They go in and take a company, they make it private, and then they start cutting employees, and that's how you make more money. So there's no coincidence that the pension funds have moved away from the fixed income to more stocks, and now to these alternatives, which are hedge funds and private equity. They need more risk to make more returns, and to do that, you have to cannibalize the system. Now, again, this one article says private equity criticisms. It says critics of private equity funds contest that private equity firms make their money for the investors without regard to the stakeholders in the business. And most of the times it's the employees, it's the management. And in most cases, the kinds of companies that private equity firms acquire are already in poor financial health, lacking in a comparative environment, or poor managers. So now private equity firms are known to go a little too far with leverage, sometimes threatening the very existence of the companies that they take private. In a recent example, private equity firms added $400 million of debt to AutoTrader just months before filing with the SEC to take it public. In seeking more debt, the private equity funds were able to suck $400 million of cash out of the firm to pay themselves as a dividend while seeking to list the weakened firm on Wall Street. So this is another way of extracting more revenue out of the system. Now, this article, we all know about Toys R Us went bankrupt, but this says Toys R Us shows how private equity companies operate. About a year ago, the company filed for Chapter 11, Toys R Us. Its private equity owners closed 800 stores and laid off 33,000 employees, skipping out on $75 million in severance pay. Now, Toys R Us did have its challenges, but it wasn't a dying business. It was cannibalized by a private equity culture that sees workers not as stakeholders, but a part of the plunder. More than 40% of the major retail and supermarket companies that have gone bankrupt since 2015 were owned by private equity companies, Newsday found. Now, Toys R Us offers a vivid example of how they operate. In their 2005 leverage buyout, two private equity firms, Bain Capital and KKR and Vornado Real Estate Trust, immediately piled on over $3 billion of new debt. With 97% of its operating profits now going to pay interest, the company had little left to fix up its stores. How could it compete with Walmart, much less Amazon? There was no cushion when the Great Recession hit. Basically, the investors had put the company in handcuffs, seized its life vest, and thrown it into the ocean. If Toys R Us had survived, the investors would declare themselves geniuses. If they didn't, they'd walk away after collecting $470 million in interest and advisory fees. So this is, again, kind of what's happening with the market. The pension system is underfunded, so now they need more risk, higher risk, and to get even higher risk, they have to cannibalize companies. So they're basically destroying the company to fund pensioners. That's really what's happening. So I wanted to show you this because the pension fund portfolio should be more conservative because people are looking to retire and they want to make sure their investment is going to be there. But right now, it's shown to be very risky, and that's only part. It's even worse than that. Now, according to the Board of Governors of the Federal Reserve System, I got the data from the Federal Reserve, U.S. states pension assets versus liabilities. This was 2007, before the financial crisis. The states' total pension assets were $3.26 trillion, and their total liabilities were $4.89. So they were underfunded. The shortfall in 2007 was $1.6 trillion. Well, what is the most recent data? Well, look at that. The state's total pension assets have increased a bit from 3.2 to 3.8 trillion, but look at the liabilities have gone from 4.1, they've almost doubled to 8.04 trillion. So the state's total pension shortfall is now 4.2 trillion. So this, not only are the state's assets highly risky, their liabilities have ballooned in the last 10 years. This should have government pension people very worried. And this is another reason probably why the younger generation does not want to invest in the typical investment assets, because they could see that there's a lot of problems, underlying problems and leverage with the market. Now, this chart actually comes from the Board of Governors Federal Reserve System website. This shows state and local governments' pension funding status 2002 to 2016. We've got Illinois, we've got New York and California, some of the larger states. You will notice before the 2008, which is right here, crisis, the assets, which are in blue, to the liabilities, which are in red, were quite minimal. But after the crisis, they ballooned. They doubled and then tripled. The total three states funding liabilities increased from $577 billion in 2007 to $1.54 trillion in 2016. That's not quite triple, but we could see we're not fixing anything. We're just making it much worse. So I believe when the markets begin to really roll over, the U.S. state pension system is going to be in severe trouble. Because not only are they invested in very risky assets, they're extremely underfunded. So this is a big reason why people should be investing in gold and silver. Now, this last chart is on the Dow Jones Index. I haven't done an update on it, but I wanted to show because the Dow Jones did exactly what I thought it was going to do. After we had the major sell-off in December, and on Christmas Eve, it was the worst Christmas Eve ever in the Dow Jones history. We see it fell to a low of 21,750, and then on the 26th, we had this remarkable recovery. And since that time, the Dow has gone up. And what has it done? It's gone back to the moving averages here. Now, if we look, a associate of mine sent me a chart of the Dow Jones with this downward resistance line, so I wanted to add it. We could see right here on these peaks, that's where we're at. We could see this downward resistance. And right now, in February, the first day of February, the Dow opened, it went up and it closed. And as you could see, it did the same thing. These are kind of like mini shooting stars here. So it will be interesting to see what happens on Monday. I have a feeling the market will start trading in the red. I do believe we've seen a peak here. If the markets go higher, I would be very surprised. Anyhow, I do believe as I shown in my last video, the overall economy is rolling over. I do believe the Dow Jones, I wouldn't be surprised to see it really start selling off in the first and second quarter. And that's going to be very bad for the U.S. state pension funds, which are extremely underfunded and hold very risky assets. So I wanted to conclude by saying I'm going to continue to put out articles and videos on what I believe is the new age precious metal investor, which is the millennials. I do believe because they're very cautious, they're very concerned about the market. I do believe gold and silver are going to be very wise investments for them. So not only will the older generation buy more, we're going to see more demand from the younger generation. So I wanted to thank you for watching this new update. And if you haven't yet subscribed to the SRS Rocco Report YouTube channel, please consider doing so. Thank you very much.